My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Mr. James Kostohryz. James, for those who are not familiar with you, introduce yourself. Who are you? What's your background? You and I have been around a while on Seeking Alpha, so I'm glad we finally get to connect here, but give us a little context on who you are.
Yeah, Michael, hey, thanks for having me on your show. Well, I've been involved in the investment business for over 20 years. I started out, like many people in this industry, as a sell side and then a buy side analyst, covering emerging markets, various sectors like financials, oil and gas. Moved on to head up a large proprietary trading desk at a major investment bank. And then I went out on my own, just managing my own accounts and doing consulting for institutions in portfolio strategy. I was a portfolio strategist for the latter part of my career when I was actually working for institutional firms. And I continue to do sort of institutional portfolio strategy consulting for quite a few years. And then, not too long ago, about 3 years ago, I started a subscription service on Seeking Alpha, kind of like the one that you have, that serves individual investors as well. An effort on my part to kind of reach out to individual investors other than the institutional clients I've been serving for many years. And that service, by the way, is called Successful Portfolio Strategy, and it's on the Seeking Alpha marketplace.
Take us through what it means to have institutional clients. What's the nature of the institutions? How do they think about asset allocation, timeframes? Talk about that, because that term is thrown around a lot, but I don't know if people really understand what it means.
Well, that's a great question, because there's a lot of institution. There's not a. They can all be extremely different. So you can have, let's say, you have a range, and especially in terms of size. So you have large institutions, places like that are like Wellington Management, Fidelity, Putnam, some of the major money management firms that are looking for independent research other than the research that they get on Wall Street. You have the larger hedge funds. Then you have what I'd say is a different tier of the market, which are sort of smaller hedge funds and also RIAs, registered investment advisors. Registered investment advisors are some of the larger ones. They invest fairly significant amount in research to try to get independent research. All of them have access to Wall Street research, which they essentially get for free. Well, it's never for free because obviously they're paying, their trading accounts. But some of them do want to invest in independent research. And so A's are another type of institutional investor out there. So it's a kind of a wide gamut of potential institutional clients that I have served over the years. And they have very different styles. So if I can answer some specific questions for you, but styles range from very kind of long-term oriented and low turnover to other clients that are like hedge funds that are the market's trading almost on a daily basis and making sophisticated trades using options, and versus other clients that don't use options at all and they just do plain vanilla stuff. Yeah, so it really covers. I'm really covering a wide variety of clients that have a lot of different needs right now. So, but I'm happy to answer any questions that you have about different institutions and what they do and what they're thinking and so forth.
Yeah, I mean, I think the thing that's always interesting when it comes to any discussion with any investor, whether it's retail or institutional, is what's the time frame, right? So in theory, right, institutions should have an unlimited time frame to some extent, although obviously their end client's advisor has to deal with the client's own restrictions. But I don't know, personally, I find that idea kind of nonsense, because even if an institution does have, in theory, a long enough time frame to weather drawdowns, it's still run by people that get sucked into the small sample of the here and now of volatility. So when you think about portfolio construction and doing that consulting work for different institutions, how do you think through that time frame question for the various types of clients you've got?
I mean, that's a great question. So this question of time frame is a constant challenge of mine. I think it's a challenge for the clients, but it's also a challenge of mine to try to tailor, what I do to the actual time frame needs, as opposed to maybe the time frame needs that are being communicated to people in their perspectives. I mean, the reality is, Michael, and you've been around this business and you know this, which is that regardless of what the fund says in the prospectus or what a manager is telling his clients that they have a long-term focus and so forth, the reality is that a lot of these guys feel like their jobs are on the line on an annual basis, and certainly their bonuses are on the line. But also, they're just the fact of the matter. Their jobs are on the line. One bad year of performance, you're out of a job, and so that means that the reality is that what these clients are generally looking for, even though they say that they're long-term investors that look 5 years or more out and they're trying to achieve investment results that are really long-term oriented, the incentive structure for the managers is such that the managers are out there looking for short-term performance. That's one thing. The other thing is, from an institutional perspective, institutions are also very aware of the fact that their clients are short-term oriented. There's not that many clients that are going to stick with a fund or a portfolio manager that's underperforming benchmarks and or losing money, because you can actually have a situation where a portfolio manager is outperforming benchmarks, but the market's down. They're not going to stick with those managers very long. So there's tremendous pressure, on the part of these institutions to produce performance on a quarterly and on a yearly basis. And I think that this actually does kind of make it very challenging for them to actually achieve good results in the long run. And yeah, it affects the type of work that we have to do, because again, if you have a client and they need performance in the short term, you need to be really mindful of the short term, both in terms of it's particularly on the risk side, and not making portfolio decisions that are going to cause you to get way behind your benchmark. That's going to be very difficult for you to catch up. And that's unfortunate, because some of the best opportunities are sometimes opportunities where you need to take a large position and be willing to absorb a loss, or maybe absorb underperformance for some period of time for that to pay off. But that becomes a limitation when portfolio managers are really focused on short-term performance.
Part of that discussion is also around sort of defining risk properly. So, like a lot of advisors, as you know, they have conservative, moderate, aggressive buckets, so to speak. Usually it's based on age, based on need. And usually conservative is, correctly so, at least usually, overweight significantly in income producing assets, mainly bonds. This year, I think we can all agree, has been bizarre in that you look at a lot of the risk profile portfolios, conservative versus aggressive. Aggressive has done better than conservative in a lot of cases, certainly on a risk adjusted Sharpe ratio basis. How do you think about defining something as conservative versus aggressive when you're talking to an institution? Because that's a big part of trying to match the volatility with the required return.
Well, I don't think this is going to surprise you, because you've been in this business, but I've found that institutional investors are surprisingly unsophisticated when it comes to the sort of risk management, and in particular attaining risk adjusted returns. Very few institutional managers are out there actually targeting risk adjusted returns. I think that you and I would probably agree, and you and I have never spoke about this, by the way, but I'm familiar with your work, would probably agree that achieving risk adjusted returns should probably be a very important goal, and it's a very important metric that managers should probably be looking at, and that managers should be judged by. But the reality is that very few people are actually judging managers by those types of metrics. They're just being judged on simple returns, like how much were you up this year? I was up 11%. What was the S&P up? It was up 15%. Oh, you underperformed. They're not saying, oh, I achieved that 11% performance with far less risk. It seems that nobody cares. Like, in other words, the clients don't really care. So therefore, institutions are not really tailoring their portfolio management around that type of let's say, approach. And also, quite frankly, a lot of managers just don't have that particular training, because in a sense, I don't blame them, because they don't need to have it, right? In other words, if they're not looking for risk adjusted returns, if that's not a goal of what they're actually doing, then they don't need to be very sophisticated in terms of how risk is measured and how they think about risk. Probably the thing that they think about the most is again, it's always not underperforming benchmark by too much. You're not also underperforming the other competitors, your competitor funds, and therefore how far you're straying from the benchmark. That becomes kind of the measure of risk. The measure of risk isn't like how much money my client's going to lose. It's really kind of, well, how much risk do I have of underperforming my benchmark? So if the market is down, whether it be bond or stock market, or let's say in a year like this, for example, where both bonds and stocks were way down, I mean, a lot of these managers are like, well, if the market's down 20% and I'm down 20%, I'm fine. That's not at all how I manage my money, nor how I advise people in my service, in my service for individual investors. And I definitely try to educate my institutional clients, and a lot of them have, really agree with me and have bought into sort of my ideas on risk management and risk adjusted returns. But part of the feedback from them is that the problem is that a lot of clients actually don't seem to care. So a lot of the industry is kind of natural. It's, this is a business. It's about supply and demand. And if the clients really just demand absolute performance and they don't care about risk adjusted performance, then the industry is going to kind of move in that direction. I think that's probably, has that not been your experience, Michael?
Yeah, and it's also I think one of the most underappreciated and frustrating aspects of the industry, which you could argue is kind of an outgrowth of the QE era, is that, as you correctly said, most people will consider your performance against the quote unquote benchmark, which for 99.9% of individuals and institutions is the S&P 500, when in reality that's not the proper benchmark for most strategies, right? Let alone factoring in the risk tolerance of that as the baseline.
Yeah, that's absolutely right. And it's very much a challenge, I think, for some of these managers. I mean, I think that one of the things that there's different ways to kind of look at this and approach this, but I'm very much a proponent of placing a large weight on managing risk on an absolute return basis. If you can avoid large drawdowns and, whatever, but you end up sacrificing some of the upside in big years, we're able to kind of have consistent sort of positive performance, or at least not get major drawdowns. I think that this is something that there's a market for that. In other words, there are particularly a lot of individuals that would make that trade-off. And however, there's not a lot of people out there sort of marketing that type of a product, and it's also hard to necessarily promise that. But I think that, to the extent that managers are able to achieve that type of performance for their clients and show it, a lot of people are attracted to it. I mean, in my case, I've had a number of consecutive years of very positive performance. In a year that the market, for example, this year was down hugely, we've been up. During the COVID pandemic, we were flat to slightly up, when the market was down 30%. But then of course, but we did underperform during the big rebound. And we didn't get into the arcs of the world and the stocks in their portfolio and the non-profitable tech and these types of things that were really flying. And so, yeah, your portfolio is going to sort of underperform during that period of time, but there's a lot of risk obviously associated with that. It also pretty much buying certain stocks like that are going to violate just about every investment principle there is. But if you're out there just chasing performance and you're out there just trying to like equal the benchmark, then you're going to end up having to buy a lot of stuff that doesn't make any sense from an investment standpoint. So philosophically, it's important to really understand what you're doing and to know what you're doing and then stick by your guns. And I know that in your case, you've talked about this a lot this year, how you have a system and you've stuck by your guns, even in a year where, it's been difficult. And I think that as long as when one educates your clients in advance about exactly what it is that you're trying to achieve, and then you can show them that you're actually able to achieve that. In my case, it's, there's been a lot of emphasis on always achieving or having a significant focus on absolute returns, not just on, alpha or returns relative to a benchmark. Then that's important. That, if you've educated clients over a number of years, they understand what you're doing and you're able to produce results, then that works out. But having said that, that's not how the majority of the industry operates.
Yeah, and it's in hearing you talk through that. It's all throughout so I used to have this ad I was running for the Lead Lag Report. There's a video clip of my father talking about sort of the Wyckoff chart, and the copy on the ad I would run would say, "To kill it in the stock market, you have to not get killed," and that kind of alludes to the idea of big drawdowns. I said, to kill in the stock market, you have to not get killed. I never said anything about getting killed in bonds, right? Which is what really happened this year. And this is sort of the challenge, I think, when you even when you're dealing with institutions. I mean, I talk to advisors all day long, as well. It's hard for people to really understand that what happened this year, based on all of history, based on asset allocation, it really has no precedent. We can argue that bonds were more overvalued than stocks from here to tomorrow. That says nothing about the path interaction against volatility and the dual drawdown of the two acting almost the same, almost indistinguishable. So if you're in bonds, it looks like your stocks, right? Which is really bizarre in and of itself. How do you think about communicating to clients, to your own research subscribers, when you're in an environment which is odd and unlike anything we've ever seen? How do you communicate to clients that they have to stick to your own approach, your own methodology, which presumably is based on history, is based on some kind of historical cause and effect, because everyone falls for the small sample, unfortunately.
That's a tough one. It's sort of, for example, I went through a rough period in 2020 and some of 2021 when the market was really flying, and I was more cautious in the market. And the market, in terms of relative performance, I was getting killed in terms of relative performance, but in terms of absolute performance, I still had a solid year in 2020 and 21, positive returns. And on a risk-adjusted basis, my returns were extremely stellar. There's always going to be some clients, that's not going to be enough for them. And they're going to be like, hey, why weren't you buying Tesla? Why weren't you buying fintech? Why, and it's just something where you say, that's not how I manage money. I have certain principles that I stick by, that I've stuck by over decades in terms of the types of asset selection, stock selection criteria, and also in terms of just asset allocation. There's also certain rules and so forth that I stick by, and for most of my clients, I've talked to them about this for years in advance. So for clients that have been with me for a while, then that education process, helps a lot. And particularly if they've already done well with you in the past, they're going to kind of ride out those bumps. But sure, it's very challenging, particularly with, whenever you have, let's say, newer clients that are coming on board and they suffer a period of let's say, underperformance, and to try to convince them, like, hey, yeah, this system works, but they see the evidence in front of them that during that year, for example, that first year that they've been with you, that it didn't work. That's the only thing that they're really focusing on. So I think that the key is, like, you really have to, and I hate to use this word sell, but it kind of is that you have to sell people on your philosophy and on your approach. And when you have really done a good job of explaining to people why you do what you do, and you sell them on that approach, I found that works and they stick with you. But it's all about it's essentially all about education. It's about an educational process of explaining to people in great depth why it is that you're doing what you're doing. Why is it that you're not doing, for example, what other people are doing and seems to be working at that particular moment? And then people that are in broad or essentially in agreement with your philosophical approach are going to be your long-term clients. And I'd say that's the other part of this is just, okay, you make the best, you do the research, and your back tests and your historical research, and you look at the rationale behind everything you do. A lot of people, just derive value from that. And if you're doing a good job of providing that type of analysis, even if people don't agree, that's fine. And so there's a lot of clients that I have my portfolios and my personal portfolios that I show them as, in the form of model portfolios, but this is actually real money that I manage. And, some of them choose not to copy the portfolio 100%. Some of them might want to put in other types of stocks or whatever, and that's all fine. So you just be very, or what I try to do is just to be very upfront and transparent about exactly what it is that I'm doing, and provide that type of education and let the chips fall where they may.
Yeah, no, I'm with you. I'm glad you use that word it's working for now, or you said who knows what's going to keep working, right? We'll touch on that, because I always have an intellectual problem with the idea of, well, you should just change your approach or try to adapt to the current environment, because it assumes that the environment persists, and it assumes that you can create a foolproof strategy, which is impossible, right? So I want to hit on that, but let's get some of the audience.
I think you're absolutely right, and it kind of goes back to what I was talking about before, which is that most family wealth managers really are just going are kind of catering to what's out there in the environment, and catering and to kind of the beliefs that their clients already have. Taking a client and kind of pushing back against them a little bit and trying to educate them is obviously a little bit of a risk. You may not land the client if you kind of push back against their expectations when you onboard them, or if you kind of push back against their beliefs. And it's also a hard process to try to educate a client, right? It's not, if you're going to, for example, show a client the history of the markets and how drawdowns are pretty frequent and can be very painful, teach them about valuation. And there are people that I've literally listened to that are managers in family offices that run hundreds of millions of dollars. And I'll start talking to them about valuation, and they'll say things like, "That's just old fashioned. I mean, valuation doesn't mean anything anymore. That's all BS. That's not how the market works anymore." So, but so that's sometimes you just in a situation like that, you can do one of two things. You can either throw up your hands and either choose not to work with people like that, or you can choose to go through the painful process of trying to educate people like that and show them, hey, the concept of valuation isn't obsolete, and very patiently and in a long-term fashion, try to educate that client. And that's kind of the approach that I've managed to take. But, admittedly, you'll lose clients that way. So, when you're talking about family managers, I mean, that's a sales business, and they're in the business of trying to capture as much assets as they can. And therefore, as you said, becomes an echo chamber, because they're not necessarily pushing back against the kind of these type of these beliefs, as you pointed out, that stocks, pretty much only go up and up and to the right, and the returns are 10% a year or more. I think there is going to be something of a reckoning, because I think that without being any doomsday about it, I just think that returns are going to be a lot harder to come by during this next decade or couple of decades. And that's going to mean that a lot of managers are going to have very, very rough and tough conversations with their clients, a lot more than they were during the last 20 years, where everything was just going up and to the right, as you said. A lot of family managers this year, they're obviously having very tough conversations with their clients this year, and it's pretty horrible. But I think there's going to be a lot more of that in this next decade. It's just not going to be as easy to make money in the next, let's say, decade or two as it was in the last 2 or 3 decades.
By the way, it really hasn't. I mean, this is going to sound like a strange statement, but I'd argue it hasn't been easy to make money the last decade, too. I mean, look, bonds just went through effectively a lost decade. Emerging markets went through a lost decade. So I know, to your point, James, I'm kind of with you in that while I deeply believe nobody can predict the very long term, the future in that way, it's not outside the realm of possibilities that we are in the midst of another lost decade.
Yeah, I mean, I want to just clarify what I said. I mean, I don't think it's ever been easy to make money in the markets. I guess what I just mean is, I meant by that is, one of the things I meant by it is like sort of buy and hold. It's interesting because even one of the things that I've definitely learned is that it isn't actually easy to make the market return with a buy and hold strategy. There's empirical evidence that shows that clients simply don't stick with a buy and hold strategy. When there's a big drawdown, they tend to sell. I mean, that's just reality. So what that tells you is that you need to protect clients against major drawdowns, because as much as you want to educate them until they're blue in the face about how they need to kind of stay the course when the market's down 25%, the reality is that they don't do that. And basically what that means is that, a lot of managers don't actually understand their clients, or they actually think that their clients are going to be kind of what was that phrase that's used with the crypto? They're going to be like stone hands or whatever, like diamond hands. But the reality is that the vast majority of people aren't diamond hands. And so if you don't protect them from the big drawdowns, they'll actually make the big mistake. So I guess I'm just kind of that's a little bit of a digression from this, just to kind of affirm your idea, Michael, that it's never easy to make money in markets. And in terms of what we have going forward, I think it's going to be a lot tougher. Valuations being as high as they are means that forward returns are going to be lower than they have been in the recent past. I think that we're also probably facing, we can discuss that if you'd like, on a secular basis, we're probably facing a decade where we're going to have significantly higher inflation and higher inflation volatility than we've experienced in the last 3 decades. And that's going to really be a game changer in terms of valuations and in terms of growth. And so, during this next decade, a lot of the returns that we got in previous decades from PE expansion just aren't going to be there. And I think a lot of the growth isn't going to be there either. So both on the side of growth and on the side of PE expansion, we're just looking at very, very much rougher times going forward. In the bond market, you mentioned we were in, up until recently, something like a 30-year long bull market in bonds, 40-year old bull market in bonds practically since the early 80s. In an environment in which inflation volatility picks up and inflation is going to be more of an issue than it has been in previous decades, I think bonds are going to have a rougher time. But you're certainly not going to get the type of outstanding returns from bond portfolios that you got in the past. That's definitely not going to happen because bond yields are not going to fall to strongly negative levels. At least here, I don't think that's going to happen in the United States. So that means that if we think of our bond yields in the United States as having a bit of a zero bound, which is not absolute, of course, but as long as we think that we're not going to be going the route of Europe here in the United States, then there's kind of an upside ceiling to returns on bonds, but there's not much of a floor because if inflation really does flare up, obviously the downside can be a lot greater. So I do agree with you, Mike, and the prior person who posed the question that we're going to be in for a tougher decade. One of the things we might want to discuss, by the way, Michael, and I want you to lead the questioning and so forth, but we might want to also talk a little bit about kind of the current market and prospects for 2023. I don't want us to kind of forget about that. But I mean, some of these issues that you're bringing up are certainly very important.
Yeah, that's a good transition. And then I want to bring for questions here. Let's talk about that because, you put out a piece on Seeking Alpha, the most anticipated recession in history. And I always have this kind of interesting back and forth, even with myself, around, market efficiency, right? It's like if everybody sees the train coming, it can't possibly hurt you. But maybe it's just coming faster or harder than people realize. Talk through some of your thoughts on where we are in the cycle, how you think next year plays out, and if the fact that everyone's talking about recession maybe makes it either worse or not as bad as people think.
Yeah. Well, to be honest with you, Michael, I wrote that article on Seeking Alpha, and I'm actually just kind of in the process of thinking through this because it's a very tricky thing. But I'll kind of talk a little bit about this particular dilemma, right? I did a pretty extensive survey looking at a whole bunch of different sources, looking at professional forecasters, surveyed corporate executives, and also surveys in the financial industry of fund managers and even individual investors. And what I found is that there's an overwhelming consensus that, we're going to have a recession in the next 12 months, an unprecedented consensus. I won't go through the actual details of the numbers, but basically for each one of those constituencies, the numbers and the percentage of folks that are actually anticipating recession are really unprecedented for times when we're not already in recession. In other words, there's been a couple of times where the numbers have been this high when the economy was already in a recession, for example, as like in 2008. But prior to a recession, never has there been such a high level of conviction that there was going to be a recession. So that obviously brings up the question, well, if everybody is anticipating a recession and if this consensus is so great, then it must already be priced in, right? And I think that's the knee-jerk, kind of obvious, almost conclusion to draw from that. But I think this is where we have to apply more of some more second order or second level thinking here. Because again, if a conclusion is too, this is almost like a third order thinking because people think, well, if recession's already the consensus, then it must already be priced in. You could argue that that's second level thinking, but I would argue that at this stage of the game, that simple level of contrarianism is really just first order thinking. And in other words, it can't possibly be that easy. And so where are the kind of holes, or what are the things, some of the things that I'm looking at that may actually provide a surprise relative to this idea that maybe it's already all priced in. The first thing is that when you look more deeply at this data, what you find is that even though a vast majority of people or a large percentage of people are, in vast majority of the constituents in some cases, are expecting recession, when you look deeper at the actual data, what it shows is that people are expecting a short and a mild recession. That's a very important distinction, because when you ask the question about whether there's going to be a recession or not, that's like a binary thing. It's like, okay, there's going to be recession or no recession. But the reality is that economic outcomes are not binary, right? You can have a strong expansion, weak expansion, a soft landing. You can have a mild recession. You can have a recession of average intensity, or you can have a really severe and long recession. There's a whole gamut. And when you look at market history, those types of outcomes are strongly correlated with the peak to trough outcome in equities. In other words, it doesn't just matter whether you have recession or not. It actually matters how strong the recession is, how long it is. So what I think that is being missed here is that a lot of opinion is really concentrated, or in other words, there's a very strong consensus around the idea, not that there's going to be a recession. That's not the interesting thing. The interesting thing here is that there's a really strong consensus that there's going to be recession, but it's going to be pretty short and mild. What that leaves us open to are the other possibilities. And we have to kind of think through, okay, what happens if recession isn't short and mild? What if the recession, on the one hand, there's one possibility, and we'll talk about each one of these different possibilities, but one possibility is that we don't have a recession at all. And that, in fact, and one possibility is a soft landing. But hey, there's another possibility that we may not even get a quote unquote soft landing. Maybe the economy just continues to be stronger than anybody expects for longer, and we never really have anything that resembles a soft landing. Then, of course, then we have this soft landing scenario where, again, this is out of consensus, but it's not really that far out of consensus, because when you really look at what the definition of a soft landing is, it isn't all that different from what a mild recession looks like. In fact, I would argue that, definitionally, it's very difficult to actually really pin down the difference between a soft landing and a very mild recession. When you look at, for example, historical examples of things that were considered to be soft landings, they look a whole lot like episodes that are considered to be mild recessions. So there's a lot of ambiguity there. But then, of course, on the other extreme, there's the possibility that this recession won't be short and mild, and that it could actually be longer than people than people expect, and more severe than people expect. And clearly, people aren't positioned for that. I mean, that's based on the survey data, but also, we need to look at market prices, right? And we look at market prices across the board. A lot of people say, well, yeah, the market's already down over 20%, so clearly there's some sort of recession priced in. I'd say no. That's not what's actually been priced into the market. That doesn't appear to be the case. If recession was being priced in, we would see spreads on corporate bonds significantly higher than they're at. I mean, spreads right now on corporate debt and high yield in particular are more towards the lower end of historical ranges than towards the upper end. If people really were anticipating a recession, spreads would be not even within the historical range, not even at the upper end of the range. They would be above the upper end of the range. So clearly, the pricing of corporate bonds tells us that markets aren't really anticipating a recession. And to the extent that they're anticipating a recession at all, it has to be one that's so mild as to almost be irrelevant. We can see this in PE ratios, or if you prefer, we can look at something like an equity, implied equity risk premium. Valuations, and in particularly implied equity risk premiums, are not implying by any means a lot of fear of recession. In fact, it kind of suggests that those valuations don't suggest that there's much of a fear of recession going on at all, or if there is, it's something that's so mild as to almost be irrelevant. When we look at earnings expectations, both bottom up and top down, Wall Street consensus is still expecting moderate earnings growth. Historically, in a recession, earnings contract by 20 or more percent on average. Certainly always a significant contraction. So when you look at a number of different indicators and look at it from a number of different angles, it's pretty clear that the market isn't even moderately pricing in a significant recession, and therefore the market will be in for a very nasty surprise if one actually materializes. So these are the kind of questions that I'm kind of posing. I don't have and we can go through, you can ask me what I kind of think are the probabilities of these different scenarios panning out. But I think the main point I want to get across right now is that we shouldn't be thinking about recession as a binary thing. There's probably more I would divide let's say, of course, there's actually a continuum, right? It's almost like an infinite continuum, but we could divide it maybe into 4 different scenarios. One, we could call it uninterrupted expansion or a slowdown that's not significantly below, say, trend growth. There's another scenario where we have the so-called soft landing. Another scenario which we could call short and mild recession. And another scenario, which is really a whole bunch of other scenarios, which are, let's say, a recession of average intensity and length, and then other possibilities, beyond that, of recessions that are above average. These are kind of the 4 different, I'd say, buckets of scenarios that we have to kind of look at, and we have to look at what are markets actually pricing in relative to those different scenarios. And that's how we probably need to, that's the kind of the basis that we need to use to construct our portfolio strategy and our kind of strategy for 2023. Not this simplistic idea of hey, recession is clearly already priced in because it's such a strong consensus. And hey, look at the market's already down 20%. On that front, I'll just point out that, again, market pricing doesn't suggest, this 20% drawdown. It hasn't. The best interpretation of this is not so much that the market has been pricing in recession, but simply there's been a contraction of PE ratios that have occurred as a result of the increase in nominal and real interest rates, which is a very different thing from pricing in a recession. So in any event, Michael, I'll kind of open it up to you to kind of explore any of the different paths or that I kind of laid out there and different possibilities.
Let's get some of the audience based on that, because I think there's a lot that we can kind of tease out in a relatively limited time here.
Well, that's an interesting strategy. I mean, I certainly wouldn't be an advocate of that particular approach. In my own case, my own, let's say, investment philosophy is, although I obviously have enormous respect for Warren Buffett and Berkshire, I do use a lot of asset allocation and what some people would call market timing in my approach, and it's worked for me. It's been very successful. I actually think that it's actually, and it's never easy, but I actually think it's more realistic to get alpha from some low-hanging fruit in terms of market timing than it is these days to get that alpha from picking individual stocks. That's, of course, a very long conversation about, how to try to get alpha from picking individual stocks. I think actually a lot of the alpha that people can get from picking individual stocks actually has to do with understanding where you're at in the cycle. Because if you're deep in a bear cycle, there's going to be a lot of undervalued stocks. But the thing is that you have to be liquid and you have to have cash in order to take advantage of those opportunities. When you're in the middle of a bull market, I think it's very, very tough for any individual investor, other than the most elite, to actually outperform the market buying individual stocks. But again, that's a separate issue. In terms of Berkshire specifically, I mean, I haven't really seen a lot of evidence that Warren Buffett has really, let's say, been hugely successful in really just outperforming the market and doing an amazing job the way he did early in his career. And when I look at some of the stuff in his portfolio, I haven't been let's say, blown away. His biggest holding is Apple, and I happen to think that Apple is a very overvalued stock. And I think from the perspective of a value investor, The fact that he hasn't sold out of that stock leads me to question a little bit, like what he's doing. And there's been some other things like that. So I think in general, for example, if an individual happens to be a big believer in Berkshire and in Warren Buffett, that's a great thing. I personally, have a different portfolio management strategy and philosophy. And also, even if I was looking just for kind of a stock picking, kind of a pure stock picking approach, I'm not sure if I would necessarily choose Berkshire. I mean, I'm just being perfectly frank here. I know that's not a popular response, but I'm just trying to be frank. I don't know that they're screwed. I think, for example, dividend stocks have a pretty strong tilt towards cyclicality. And I do actually think that on a risk to reward basis right now, a lot of the cyclical sectors are my favorite sectors. And so to the extent that a dividend oriented portfolio is kind of has a cyclical tilt to it, then I think that they may outperform, due to that cyclical tilt in the sort of in what typically is a high dividend portfolio. So I guess in terms of sort of saying like, is a high dividend portfolio going to outperform this year? I would want to know the specific composition of the dividend stocks. But to the extent that it's a kind of a typical dividend portfolio that has that kind of cyclical tilt, I would basically agree that I think that this is going to be a better environment. I think it's going to be a very tough environment for growth. One reason is that growth has clearly benefited more than any other sector from kind of easy money. And I don't think we're going to be in an easy money environment under most scenarios in the next year, certainly. I very much do believe the Fed when they say that they're going to keep money pretty tight until two things happen: until inflation is down close to their 2% target, and probably just as importantly at this point, until they've gotten the unemployment rate up fairly substantially, that the unemployment rate is ticked up, let's say, by 1% or so. Because the Fed has clearly said that they believe that the current unemployment rate is not compatible with 2% inflation, which means that they need to get employment up. And I think that's going to take time, or probably is. Under most scenarios, I think that's going to take a significant amount of time. And if it does take a significant amount of time, it means that rates are going to stay higher for longer. It means that QT is going to be continued, possibly even tightened over the course of the next year or most of the next year. And in an environment like that of tight money, I think that growth is going to continue to deflate because let's face it, certainly profitless growth is still extremely overvalued. And profitable growth, companies like Apple and Microsoft are I'd say they're not ridiculously overvalued, but they're very significantly overvalued. And I think that there's going to be some air that's going to continue to get taken out of that particular sector and bring valuations more in line with reasonable type of valuations in this, particularly in this environment. So I do basically agree that kind of particularly on a risk adjusted basis, a dividend, typical dividend, a high dividend portfolio will probably outperform or do better than growth this year, particularly on a risk adjusted basis.
Yeah, no, great question. Everybody here, please make sure you follow James. Check out his research on Seeking Alpha. Make sure you follow James, who was kind enough to spend the hour roughly with us here. And if I don't get to see you, hopefully I'll see you at some point next year. So thank you, James. Appreciate it.